Somewhere in West London right now, there is a strip of concrete and terminal glass that moves more international passengers than any other airport on Earth, and a piece of it just changed hands. Not leased, not managed under contract, bought. A slice of ownership like a share, except this share costs billions of dollars, sits inside a holding company registered offshore, and is owned by sovereign wealth funds from 6 different countries who have never met each other's citizens, let alone the passengers walking through the terminal. This is the story of what it actually takes to own one of the machines that quietly moves nearly 10 billion people a year. And by the end, you'll understand why the smartest money in this industry has stopped trying to run airports and started just trying to own pieces of them. Let's start with the unit of measurement because it explains everything else. Airports are sized in million annual passengers. A small regional field might handle 500,000 a year. A true global hub clears 90 million. From there, the industry sorts airports into a rough class system, almost like weight divisions in boxing. Non-hub and small hub airports handle the regional traffic. Medium hubs serve single countries or regions. Large hubs anchor entire continents. And at the very top sits a tiny handful of mega hubs moving more people in a year than the population of most nations. Right now, the busiest airport in the world by total passengers is Hartsfield-Jackson, Atlanta, which handled roughly 106.3 million passengers in 2025, holding the title it has kept for 27 of the last 28 years. Dubai International runs a close second at 95.2 million and remains the busiest airport on Earth for international travelers specifically, thanks to its position as a connecting hub between Europe, Asia, and Africa. Tokyo Haneda climbed to third in 2025 with 91.7 million. Hong Kong International, meanwhile, holds a different crown entirely, the world's top-ranked airport for air cargo, moving more freight by weight than any other single facility on the planet. Across the roughly 2,800 commercial airports, Airports Council International tracks in more than 180 countries, though only a small handful ever attract this kind of institutional ownership interest. But none of these are actually the airport this story is really about. That would be London Heathrow, owned by a holding company called FGP Topco, whose shareholders as of this year include the French investment house Ardian at just over 32%, the Qatar Investment Authority at 20%, Saudi Arabia's Public Investment Fund at just over 15%, Singapore's GIC at 11.2%, Australia's Retirement Trust at 11.18%, and China's Investment Corporation at 10%. Notice how many different countries just appeared in one sentence for one airport. That is not an accident. That is the entire business model. We'll come back to it. If you want to build an international airport from scratch today, there are really only 2 places on Earth doing it at true megascale: China and the Gulf. Beijing's Daxing International, a 5-year build designed by the late Zaha Hadid, opened in 2019 at a headline construction cost of roughly $17 billion, though the total bill including high-speed rail links and connecting infrastructure has been estimated as high as $63 billion. Istanbul's new airport cost around $12 billion for its first phase and was designed to eventually handle 200 million passengers a year by 2028, which would make it the single busiest airport ever built. And Dubai is now planning to go even further, with Al Maktoum International projected to cost roughly $35 billion and eventually handle up to 260 million passengers annually, a scale no airport in history has approached. But that geography is not accidental either. It's a live geopolitical contest. Airports have become instruments of national ambition the same way ports and railways are, projects meant to announce a country's arrival as a global hub in their own right, and increasingly a lever of soft power and trade leverage rather than pure transport infrastructure. Governments in the Gulf and East Asia are effectively competing to become the connecting point of the entire planet's air travel, one runway at a time. Here's the part that surprises most buyers. Even with all that ambition, you cannot simply commission a new international airport and expect it operating next year. A true greenfield megahub, from first shovel to full multi-runway capacity, routinely takes a decade or more. Istanbul's airport was first announced in 2013 and won't reach its final planned capacity until 2028, 15 years later. Beijing Daxing needed years of connecting rail and motorway construction before it could even function as intended. If you want in sooner, you don't build one. You buy into one that already exists. And this is where owning an airport stops looking like industrial procurement and starts looking like a very different kind of casino, one where the swings are measured in the billions rather than the millions. During the depths of the COVID lockdowns in 2021, Sydney Airport shares had been battered so badly by the collapse in global travel that an infrastructure consortium led by IFM investors was able to take the entire company private for roughly 23.6 billion Australian dollars, about 17.5 billion US dollars, a price that would have been unthinkable just 2 years earlier when the airport was still trading as a normal, fully booked public company. Buyers who moved while air travel looked existentially threatened locked in one of the largest infrastructure buyouts in history at what now looks, in hindsight, like a discount. Then the recovery came. Global air travel didn't just bounce back, it overshot. By 2025, worldwide passenger traffic reached an estimated 9.8 billion people, a gain of more than 7% over pre-pandemic 2019 levels, and airports that looked like distressed assets in 2021 are now running at record capacity, with congestion, not emptiness, as the defining complaint. Asia-Pacific hubs in particular have surged, with Shanghai Pudong jumping from 10th to 5th busiest in the world in a single year and Guangzhou Baiyun rocketing back into the top 10 from 57th just 3 years earlier. This is the defining feature of the entire industry, and it's the opposite of what drives a ship's price. A container ship's value is almost pure supply and demand for steel capacity. An airport's value is anchored to something much sturdier, a regulated asset base. Aviation regulators, like the UK's Civil Aviation Authority, effectively set a formula for how much return an airport owner is allowed to earn on its invested capital through landing charges and passenger fees, adjusting it periodically for inflation and investment. That regulatory settlement doesn't eliminate volatility. Rising interest rates alone can knock billions off an airport's valuation overnight, because so much of its worth is calculated as the present value of decades of future regulated cash flow, and that math is brutally sensitive to the discount rate applied to it. Passenger forecasts, inflation assumptions, and the regulator's allowed rate of return all move the number sharply too. But underneath all of that, an airport keeps generating a contractually anchored cash flow through good years and bad, in a way a container ship, whose earnings depend entirely on a spot freight market with no floor and no ceiling, simply never does. So say you've found your airport and your moment. How does the deal itself actually work? Because buying into an international airport looks nothing like buying a company off the stock exchange. You don't hire a broker and sign a one-page memorandum. You run or join a competitive sale process managed by investment banks, subject to a shareholders agreement that typically includes a right of first offer, meaning existing owners get first refusal before shares can go to an outsider, and full tag-along rights, meaning if one major shareholder sells, the others can insist on selling alongside them on the same terms. That's exactly the mechanism that turned Ferrovial's single-planned exit from Heathrow in 2023 into a cascade that eventually saw 6 different shareholders across 6 different countries end up holding stakes. Once terms are agreed, the deal closes subject to regulatory approval from competition authorities and often a national government sign-off, because unlike buying shares in an ordinary company, owning a piece of critical transport infrastructure is treated as a matter of national interest almost everywhere, and that national interest shows up in blunt rules. Australia requires Sydney Airport to remain at least 51% Australian-owned no matter who else buys in, which is precisely why its 2022 takeover consortium was built almost entirely from Australian pension and superannuation funds, even though global infrastructure money was desperate to get in. Many countries impose similar restrictions on foreign control of airports, airlines, and other strategic infrastructure, treating the sky above a runway a little like the flag on a ship, something that has to answer, ultimately, to a national authority no matter which passport the money behind it carries. But the money itself rarely stays on shore. The holding companies that actually own these stakes are frequently structured through tax-efficient jurisdictions like Luxembourg or the Netherlands, regardless of where the physical runway sits, the same logic that sends container ships to fly a Liberian flag administered out of an office in Virginia. Ferrovial itself, the Spanish infrastructure giant that spent 17 years as Heathrow's lead shareholder, relocated its own corporate headquarters to the Netherlands in 2023 for exactly this kind of structural efficiency. The physical asset stays fixed to its coordinates on a map. The ownership and the money around it are almost weightless by comparison. You have your stake, you have your structure. Now comes the part nobody budgets for properly, actually keeping the airport running. A major international hub like Heathrow supports a total site workforce estimated in the tens of thousands once every airline, retailer, security contractor, and ground handler on the property is counted, though the airport company itself directly employs a much smaller core team. Staffing costs, security, air traffic coordination, baggage systems, and runway maintenance all run continuously regardless of how many passengers show up on a given day, which is exactly why an airport's revenue split matters so much. Roughly half of a major hub's income comes from aeronautical charges, landing fees, and passenger charges paid by airlines, while the other half increasingly comes from everything else: retail concessions, parking, real estate, and airport-branded developments. A revenue stream airports have been pushing hard to grow because it isn't capped by the same regulatory formula that governs landing fees. Insurance runs through its own specialized global system too: aviation liability and war risk pools that spread catastrophic exposure, hull loss events, terrorism, third-party liability claims across dozens dozens of underwriters worldwide, because no single insurer wants to carry the tail risk of a mass casualty event at a facility processing tens of millions of people a year on its own book. Security screening and runway resurfacing add further fixed costs that barely move whether the airport runs at half capacity or sets a new record. So how does this pencil out financially for the people actually putting up the capital? Here is the single most important economic insight in the entire industry. The smartest money isn't trying to operate airports day to day at all. It's buying long-term equity stakes and collecting a regulated, inflation-linked return for decades. Companies like Ardian, Macquarie, IFM Investors, and Global Infrastructure Partners specialize in exactly this, essentially the landlords of the sky, while separate specialist operators like Vinci Airports actually run the terminals, manage the airlines, and chase the retail revenue on the ground. Vinci Airports is the clearest case study in what patient compounding looks like in this business. The company won its first ever airport concession in 1995, a pair of small fields in Cambodia. A decade ago, it still ran only a handful of French airports.